Hey guys, it's Willie, and today I want to take a look at Alibaba stock. Currently it's trading at about $121. Over the past 6 months, it's down about 38%, and if we flip over to the yearly chart, you can see that it's down about 54%. Today, I want to look at some numbers to see if, at the current price of $121, do we think that Alibaba stock could be a possible value play, and do we think we should do more research into the company to see if it's worthy of being added to our portfolios. So let's switch over to the spreadsheet, look at some financial data, and see what we can figure out. Alright, so now that we're in our Excel spreadsheet, let's take a look at some numbers, starting with revenue. Alibaba has grown their revenue over the past 10 years from about $3 billion to around $110 billion. That ends up being a compound annual growth rate over the past 10 years of 42.66%. That is absolute monster growth for any company. You look at any company out there, that is monster growth. Now on to earnings. We see a similar trend, growing from $662 million up to $23 billion. That's a compound annual growth rate of 42.55% over the past 10 years, which again is a monster growth rate for any company. Now switching over to cash flow from operations. Here again, very similar. You're looking at $1.4 billion up to $35 billion. That's a compound annual growth rate of 37.62%, which is still a monster number. Not as high as 42, but still a monster number. Capital expenditures, you see a similar trend, which is really what we expect, but it's not growing nearly as fast as revenue is. You're going from $117 million up to almost $1.7 billion. Now, a caveat I do want to interject here is the software that I was retrieving the data from for Alibaba had the CapEx for 2021 listed as a positive number, which CapEx can't be a positive number. CapEx is the expenses that a company has that are just for keeping the regular operations of the business going. Think of it as the day-to-day expenses. You know, you have to pay your employees, you have to pay for your buildings, you have to pay for, your leases, if you will, stuff like that. Just the day-to-day operation stuff that you need to keep the business going. So it can't be a positive number because the expenses aren't going to be positive. That's like someone selling you a pizza and paying you to buy it. I mean, that doesn't make any sense. So I have replaced the 2021 number with the previous year. I think, in all honesty, it'll probably be similar anyway. It may be a little larger, but I don't think it would be even as close to, I don't think it would be close to 4,000 or 5. I think you'd be looking, somewhere similar to last year. I don't think you'd see much different, but it is growing. That's the way it goes with a growing business. It's growing at 30.66% compound annual growth rate. It's not as big as revenue, not growing as big as revenue. That's good. That's good to see. Moving on to free cash flow. You're seeing that the free cash flow of Alibaba has gone from $1.3 billion to $33.6 billion over the past 10 years, which is a compound annual growth rate of 38%. Great. Wonderful to see a company growing free cash flow that we investors love at such a high rate. That is absolutely fantastic. Moving on to shares. Shares outstanding. This is where a lot of value can come from, even from a stagnant company that's not growing as much. As you can see, Alibaba's gone from 2.5 billion shares to 2.7 billion shares. Not really what I like to see as far as a company issuing shares. I'd rather see a company buying them back, especially with Alibaba shares being so quantitatively cheap. I'd like to see Alibaba buying back those shares. The reason I'd like to see them buying back shares is because it rewards investors. Just think about it like this. If you owned, let's say, 10 shares of a company that has 50 shares, so you own 10 out of 50, that means you own 20% of the company. If you don't do anything and the company buys back shares, let's say they buy back 10 shares. So you own 10 shares out of 40 shares. This means you own now 25% of the business. You've done nothing and your ownership has gone up. The opposite is true with issuing shares. So if you go from owning 1 out of 50 shares, the company issues 10, so now you own 10 out of 60 shares. That means you now only own 17% of the business. So I'm not really hyped about Alibaba issuing shares, especially since I think Alibaba shares are underpriced. I think they should be buying them back since they are at such a good value. But Alibaba is not issuing them at a rate that would concern me. They're issuing it, you only went up about, less than 1% compound annual growth rate. You're going up 1% a year. That's not something that I worry about. Anyway, moving on to earnings per share. Earnings per share have grown from 26 cents a share to $8.23 a share in 2021, which is absolutely outstanding. Free cash flow per share, 53 cents to, let me make this column a little wider, $12.26 a share. Monster growth. And the reason these aren't growing as quickly as your, say, your earnings number and your total free cash flow number is because they're issuing these shares. So, you're dividing a number by a number that is growing here to get the per share price. So it's growing slower, but still, honestly, how could I say anything bad about free cash flow growing at 37% a year over the past 10 years, or earnings per share growing at 41% a year for the past 10 years? That is absolutely monster. It is wonderful. It is really hard to find companies like these, and it's really hard to find companies like these that I think are undervalued, I'm sorry. Now on to debt. This is where I kind of evaluate the safety of the company. Debt has grown from $2 billion to almost $94 billion. That's a compound annual growth rate of 46.88%. That is somewhat concerning, considering that the revenue, earnings, cash flow from operations, free cash flow is not growing at that rate. That is somewhat concerning. However, I still think this debt is relatively affordable based on free cash flow and with cash. So if we take total debt, take your $94 billion, they've got $80 billion, $79 billion, almost 80 in cash. So you end up with a net debt of only $14.7 billion, which is less than a year's worth of free cash flow. That's less than half a year of free cash flow. So the debt is not a problem, especially with the cash they have. As a matter of fact, as you look, there are certain years in here, there's another where the cash was larger than the total debt. I'm not talking just long term or just short term. This is all the debt of the company minus their cash. You get a very small number. So it is a very, very safe company. On to return on invested capital. We saw a really big number back here. These numbers were not available in my software. I don't entirely know why, but I think you're looking, here we found a stable sort of place going from 11 to 9, around in there. Last year was 7.7. It's not bad. It's not a bad return on invested capital. Alibaba is a really big company in China, and they're an Amazon. Think of like the Amazon of China. They're not doing a very high tech, sort of like a software business, or like Intel. They get a really good return on invested capital. But Alibaba's doing more of the online shopping sort of thing, which is not going to lead to a high return on invested capital. Just like retail isn't going to lead to a high return on invested capital. But still, they've been hovering around the 10% mark. Perfectly happy with 10%. That is a good return on invested capital. Alibaba is making smart moves with their money. On to a brief overview of the company. So we look at our PEs. The current PE, it says it's cheap. We look at the 5-year PE, the current price based on the past 5 years of the average of the past 5 years of earnings. You get still a low PE, especially for a company that's growing so quickly. Price to free cash flow is very similar to PE, except that you're using free cash flow instead of earnings. That indicates it is cheap. Your debt, again, it's less than 1 year of free cash flow. Our revenue growth, good. Earnings growth, good. Free cash flow growth, good. As a matter of fact, they're all excellent. Shares outstanding, they're going up. Not something I like to see, but it's such a low rate, I don't think I'm very concerned about it. The return on invested capital, a little bit over 10%, almost 11, average. I think that's fine for Alibaba. Alright, so now let's switch over to our forecasting. Alibaba has grown revenue, earnings, and cash flow from operations and free cash flow at astounding rates. I don't think they're going to keep doing that for very long. I don't see them keeping up, say, this 38% a year for much longer. The company is big already in China. They're expanding, but they're big already. And I think you're going to see lower revenue growth, lower earnings growth, all that good stuff. But I don't know how low. I think 10% is reasonable. So for free cash flow and earnings, I said 10% growth rate over the next 10 years. I think that's completely reasonable. I would not be surprised if Alibaba was able to get something closer to 15 or 20%. But I want to be conservative here and say 10%. PE, now that I think about it, I am going to change this number. I think something more, I don't want to go 20, but let's say something more like 17. You know what? No, I'm going to keep it at 15, just for illustration purposes. That will lower the price, but I just want to illustrate how cheap I think Alibaba is. Both, so you're getting free cash flow, $467 per share. Earnings, you're getting $324 per share in 2030 with 15 PEs and 15 price to free cash. Right now it's $120. These are the prices we had. If we just average the two, you're getting about $400 a share. So if we switch over to our IRR calculator, you're in at 120, you're out at 400, you get these free cash flows along the way, and you're getting a 28% IRR over the next 10 years. You're looking at 28% a year. Let me say that again. 28% per year on your money in Alibaba. That's crazy. I mean, that is beyond belief. That's 5x your money in 10 years. That's unbelievable. Now I want to switch back over here. Remember I said I could see them getting 15% revenue growth, 15% free cash, 15% earnings growth. Let's see what that does over the next 10 years. PE 15. I think that's still low, but I try to be conservative. You're looking at $625 in 10 years. Stock price. You're looking at 35% annualized rate of return. That is, I really don't know what to say. That is such a high number. You're looking at 7.5 times your money in 10 years. That is monstrous. This is why Alibaba, I think if you go through a math exercise like this with your own numbers and come up with something like this, I really think at that point it becomes a no-brainer. Unless, I understand the worry about China and the regulation stuff, but I feel like this is just too good to not take the risk. I feel like it is. Now I want to switch over and do something else with the forecast. I want to say, okay, let's assume we're wrong. Let's assume that things go south, really far south. How bad does it have to get for us to only get a market return? To where we would have been better off just putting ourselves in an S&P 500 index fund and sitting there rather than investing in stocks like Alibaba. So let's tune it down to 0%. Let's see what would happen if the company doesn't grow any more from here. Still 15 multiples, 14%. Let's lower our multiples a little bit, because if the company's not growing, they should get lower multiples, right? They still would have strong free cash flow, and they would have low debt, being a safe company. You're still looking at 12%. Let's lower the PE to 10. Alright, so your ratios are at 10. You're still looking at 11%. That's still beating the market. Let's go down to 8. 8 PE, 8 price to free cash. You're now looking at a 10% market return. Even if the company doesn't grow anymore from this point forward. I don't see that happening whatsoever. I think the company's going to continue to grow, and I think they're going to have a multiple higher than 8. And you're still looking at a market return of 10% that you can get from an index. I think Alibaba's really cheap. I think everybody should really look into it. If you're not into the whole China risk thing and this, that's not up your alley, don't get in it. If you're worried about all that, don't buy it. But as always, do your own due diligence, do your own math, look at your own metrics, do your own numbers, read the annual report if you want to do that, read the news, read presentations, read whatever you want. But just, don't just go and trust some guy on YouTube, because, I could be wrong, everybody could be wrong. I'm in no way an expert or a financial professional. So don't trust me. Definitely do your own numbers, your own work, your own due diligence. But yeah, I think Alibaba is a really good stock, looking really good, really cheap. I think it's a good buy. But with that said, thanks guys for watching. I really appreciate it. Like, comment, subscribe, all that good stuff. And I will catch you guys in the next video.